Inflation and interest rates, the hidden game of central banks. What if I told you that the rise and fall of your grocery prices, your home loan payments, and even the value of your country's currency are all part of a strategic game? A game quietly controlled by a handful of people sitting inside glass towers called central banks? Every time you hear the words inflation and interest rates on the news, it might sound like boring financial jargon. But behind those numbers lies a powerful system that decides whether economies boom or collapse, and whether your money grows or loses value while you sleep. Central banks like the US Federal Reserve, the European Central Bank, and others across the globe act as the ultimate referees of this game. Their main job? To keep prices stable. But in reality, their actions often spark inflation or trigger recessions, depending on which way they tilt the balance. Round 1. The inflation play. Inflation simply means prices are going up. It sounds simple, but it's not. When central banks print more money or keep interest rates too low for too long, they fuel consumer spending and business borrowing. At first, this feels great. Everyone has cash, markets rally, and the economy seems alive. But soon, demand outpaces supply. Prices rise, slowly at first, then faster. Suddenly, a loaf of bread that cost $1 last year now costs $1.30. Your salary hasn't increased, but your expenses have. That's when inflation turns from an economic tool into a silent tax, reducing your purchasing power without you realizing it. When inflation spins out of control, central banks step in like firefighters, raising interest rates to cool the economy. But here's the catch: higher interest rates make borrowing expensive. Businesses cut down on expansion, homebuyers postpone loans, consumers spend less. It's an intentional slowdown. The goal? To force inflation down, even if it means risking a recession. This is the hidden game, creating short-term pain to avoid long-term chaos. Round 3. The balancing act. The central bank's job is like walking a tightrope. Raise rates too much, and you crush growth. Keep them too low, and inflation runs wild. For example, in the early 2020s, the US Federal Reserve printed trillions during the pandemic to support the economy. But when inflation skyrocketed above 9% in 2022, the same Fed aggressively raised rates, triggering layoffs, market crashes, and debt crises in developing countries. The cycle repeats, but every move creates winners and losers. Investors, governments, and global markets are all watching, ready to profit or panic. When a major central bank like the Federal Reserve raises rates, it's not just America that feels it, the entire world does. Developing countries see their currencies fall. Foreign investors pull out of weaker markets. Global trade slows down. It's a domino effect. One decision in Washington can shake economies in Asia, Africa, and South America. That's why some economists say, the world doesn't just watch the Fed, it obeys it. The hidden question: who benefits? Here's the uncomfortable truth: not everyone suffers equally. Banks benefit from higher interest rates because loans become more profitable. Wealthy investors often protect themselves by shifting into assets like gold, real estate, or US Treasuries. Meanwhile, the middle and lower class watch their savings lose value and their loans become unaffordable. Conclusion: the illusion of control. Inflation and interest rates aren't random. They're tools in a carefully managed system designed to maintain economic order and political stability. But make no mistake, central banks don't always get it right. Every adjustment is a gamble, and the stakes are global. So next time you see headlines about rate hikes or inflation easing, remember, behind every percentage point lies a hidden game, one that affects your wallet, your job, and your future.